Good afternoon, everyone, and welcome to the Florida City and County Management Association's webinar entitled Fuel Hedging for Public Entities. My name is Bob Lee, and I have the honor of serving as your host today. Joining me as co-host is Dr. Dina Hurst and Mr. Mike Ryko. Both Dina and Mike work with the John Scott Daly Florida Institute of Government, and they'll be the people who will be assisting all of us with technology needs during today's program. For those of you who have not participated in an FCCMA webinar before, we have a number of attendees. I think we're expecting well over 80 today. So you will all be muted, but if you have some questions for our presenters, we welcome those. Please use the chat box and we'll do our very best to make sure your questions are addressed by our presenters today. Sponsors for today's program include the Florida League of Cities, the John Scott Daly Florida Institute of Government, the Center for Florida Local Government Excellence, and corporate sponsors, Government Services Group, Strategic Government Resources, and Granicus. It's my pleasure at this time to introduce today's panelists. First on the left is Jeff Lemunyan, and one of Florida's favorite sons, Lee Feldman, will also be presenting. And welcome, Jeff and Lee, but before you actually begin your presentation, would you each mind just doing a summary of your background so the attendees knew who's speaking to them today? So Jeff, would you start, please?
Absolutely, thanks Bob. My name is Jeff Lemunyan, and I am the principal and owner of Linwood Capital. And what we do is create and manage fuel hedging programs primarily for public entities on a nationwide basis. My background is in commodity futures and commodities trading, and also in investment management. And thanks for the opportunity to be here and present this today.
Thanks, Jeff. And I'm Lee Feldman. I think I know most of you on this call. I'm the past city manager of North Miami, Palm Bay, Fort Lauderdale, and most recently Gainesville. Just shows I can't hold a job. And I recently retired, and now I'm the senior advisor for local government strategy for Zen City. And I'm actually doing the webinar from a hotel room in Tel Aviv, where we are headquartered. So glad to be with you.
If you gentlemen want to go ahead and get started, please do so. I'm not quite sure. I think, Jeff, are you going to start it?
Yes, okay. The first portion is me. So,
okay, great.
So just wanted to again say thank you and welcome to everybody who's online. And we can talk about fuel hedging. And there's a lot of misconceptions about what fuel hedging is and how it works. And we'll hopefully answer a lot of those questions for you all today. But the questions are: is can fuel costs be controlled? Can fuel costs be determined in advance? And the answer is yes, they can, and that's through fuel hedging. There's a number of different types of hedging, but really, when it comes down to it, it is simply establishing the price today for a volume of fuel that's going to be consumed and paid for later, and this is done by contract. So it is just taking a volume of fuel that you're going to be consuming and paying for later, and fixing the price of that today for a number of reasons. The most important of which is to manage your budget risk. And this is not unlike locking in a rate on a mortgage. So you have an idea of what that housing cost is going to be if interest rates go up, and you don't have a fixed rate on your mortgage. Your mortgage payments is going to go up, and if it goes up too far, you might have to move. So it's getting rid of that risk of variable cost in the future. And so if we look at the graph here, this is a sort of a hypothetical situation. If we had hedged, or if you had hedged 100% of your diesel fuel, and so for the purposes of our examples here today, we're going to use mostly diesel fuel. We'll see some gasoline examples in here as well. And these principles work for petroleum fuels and also for natural gas. But we'll be kind of concentrating and using diesel fuel as our example here today. So if we had hedged 100% of the diesel fuel, on December 31st of 2018 for 3 years, so hedged for 19, 20, and 21, we would have done so at a price of about $1.75 a gallon on that date. But we can see here the blue line is the spot price for diesel fuel during the 3-year period, and the orange line is where that was hedged. And so when we have a situation where spot price is higher than hedged price, that's when the hedging program is generating realized gains. And then we see if we move into 2020 with COVID hitting and prices slid off quite precipitously, that is a period that would produce realized losses. And so you'd still be paying the $1.75 per gallon net of the hedge. And then as we move into 2021, it flips back as prices have been rising essentially over the past 2 years into another situation where we have realized gains. And so it just so happens with this example, and this plays out in practice as well, that the realized gains and the realized losses typically will cancel each other out, and over the long term, the realized gains and losses will add up to something close to zero, and what you get along the way is a higher certainty of future cost. Next slide, please. So this is again looking at the same example, but we have hedging also creates lower fuel budget risk, and it's making sure that your costs stay at or below budget and reducing the need to overestimate fuel costs because you have a higher certainty of what those costs are going to be in advance. And what that does is that it frees up budget dollars for you to use elsewhere. So, for example, if we were again going back to the last slide example where we have a hedged price of $1.75 a gallon, and perhaps a budget around that, if we were hedged of $1.85, we're not going to go over that $1.75, $1.85 range. But if we weren't hedged, we'd have to budget quite a bit more to allow for the expected variability in cost and price over the ensuing fiscal periods. And so, if you were not hedged and you had the market environment of December 31st, 2018, you'd probably have to hedge something like $2.25 a gallon and leave a 50-cent cushion from what your expectations were. But because you have, if you were hedged, you would have a lower variability expected, and you could budget a lower cost and do something else with those budget dollars. Next slide, please. So what does hedging do? Again, as I've alluded to, it causes a higher certainty of future fuel costs. And so if we were to take a snapshot of what this means, the graph on the left shows us the range of expected diesel fuel costs when there is no hedging. And this was on March 4th. Obviously, the prices on March 4th were very high, very volatile, a lot of volatility expected because of what continues to go on in Ukraine. And so the blue line is the point estimate of where your costs would be over the next 3 years, and those are also the price levels where you can hedge for the future. The green and yellow lines are the expected range of expected prices into the future, and so the market shows us these things on a day-to-day basis, what the expectations are, not only of price but of variability of price, and so that's what it looks like to be unhedged. You've got, if we move to July of next year, for example, a projected cost of $2.75 a gallon, but that's plus or minus $1.10 a gallon. And so it's a very wide range, making planning and budgeting and forecasting very difficult. On the right, we see the same blue line, the same expectation of cost, but we have a lot less variability in that estimate. Why? Because on the right, this is a 90% hedge. 90% hedge means that you have taken away 90% of the uncertainty in the market. And so looking at it in a different way, if you were on the left and prices went up by $1 a gallon, you'd be paying $1 a gallon more. If you were hedged 90%, and prices went up by $1 a gallon, your costs would go up by 10 cents. And so what this does, by being 90% hedged in this example, you have a narrower range of expected costs and more certain future fuel costs, and you have a lower cash flow at risk. And this is something that we'll talk about on the next slide. So cash flow at risk is simply another way of looking and measuring risk. And so what that means is that between the expected price and the upper range of where prices could be going, how far is that? What kind of a distance is that? So if we look at July of 23 and you're unhedged, the costs for July of 23 could go up by $1.15, $1.20 a gallon, as we see on the graph here. But if we're 90% hedged, that gets cut down by 90%. And the additional cost, if the market did go up that far, would only be an additional, say, 10 or 11 cents a gallon, which is something that typically would be manageable within a fuel hedging program. So this is just another way of looking at risk and how much cash flow is actually at risk and how much exposure your organization has to fuel markets when it's analyzed in this way looking forward. Next slide, please. This is looking at a long-term example. This is diesel fuel, spot diesel fuel prices going back to January 4th of 2000. And this is to illustrate that while we have very volatile spot prices over this longer period of time, we have the orange line, which is the diesel fuel cost net of the hedge. And so you can see that's a lot smoother line, a little bit of a lag on the blue line. But this is also to show that there are protracted periods of time where the blue line is above the orange line, and that would be periods of time where the hedge would be paying you, and because your hedged costs would be lower. And so there are periods of time when that happens, the hedge is going to be paying you. And then there's other periods of time when the blue line goes down below the orange line, and those are periods of realized loss. And so what we discover here over a 22-year period is that, as I mentioned before, the realized gains and realized losses add up to something very, very close to zero. And that would be a long-term expectation if the hedging is done correctly. And the short to medium-term expectation is that you have the cost certainty that you want to manage your budgets, and also to enhance the planning and forecasting within your organization. Next slide, please. So the case for hedging creates the ability to lock in costs for several years. It's advantageous, again, planning, budgeting, and forecasting. Typically, fuel costs are going to be mostly known before the budgeting process begins for the next fiscal year, making the budgeting easier. So if you were to be budgeting fuel costs right now for your next fiscal year, how would you go about that? I mean, you could pull a number out of the sky, and that would be plus or minus $1.50 a gallon, because there's so much uncertainty in the market right now. Whereas what a continuously run hedging program would do, you're going to probably be 12 to 18 months hedged at any one point in time. And so you don't have to figure out what that budgeted cost of fuel is going to be in the future. You already know the answer because you've already priced that fuel. And so that's why it makes the budgeting process easier, because by the time you get there, you already know the answer to the question. And it is it's a financial process, mostly a financial process done with financial instruments, gasoline, natural gas, diesel fuel futures contracts. And so this does not change the relationship that you have with your fuel supplier. The fuel supplier doesn't really know or care that you'd be doing this. You're simply buying from the fuel supplier on a floating rate basis, as you always do. And then this is an overlay financial process that offsets the variability of the fuel cost at the pump. But really, the big economic news here that what's really happening is that the daily fuel market is no longer determining what your costs are going to be. You have a degree of control over that in advance, and you do it in a strategic manner through a continuously managed hedging program. And so, as I mentioned before, the expectations is that in the short to medium term, you get a budget cost certainty. Long term, realized gains and losses typically add up to zero. So there's not a whole lot of cost expectation there. The cost actually might be negative over a long period of time, depending on market conditions. And so the question is, if long-term costs are expected to be the same, whether you're hedged or unhedged, wouldn't it make sense to have a higher certainty of cost in the short to medium term? Put in another way, what value is there to not hedging? And so there's certainly a lot of value to hedging. Your organization is exposed to the risk and the variability of energy markets, and there's really not a whole lot of advantage, if any, to that exposure. And so fuel hedging certainly makes a lot of sense, especially for public entities. Next slide, please. And so let's talk a little bit about the energy markets and pricing and what drives pricing on a day-to-day basis, an annual basis. And so what we're seeing here is what's real to everybody on a day-to-day basis, and this is spot price. This is what the pump price is every day, and this goes back. This is a 2-year history, and we can see back almost exactly 2 years ago now, in April of 2020, when COVID was driving prices extraordinarily low. We saw diesel fuel. Spot diesel fuel futures bottom out at about, I think it was about 63 cents a gallon. And of course, from there, prices have steadily risen over the past 2 years. OPEC has constrained supply. Demand has grown as the economy has opened back up globally. And so with this, prices have come up. Inventories have come down because of it. And so prices have come up. We can see the little blip down there because of the Delta variant last August, Omicron coming along there in November and early December, and then we see the big spike there for the Russian invasion of Ukraine, and prices have been very, very volatile since then. And so this is sort of the what's real pump price, what everybody thinks about when they think about the price of diesel fuel or gasoline or natural gas. Next slide, please. So, but with these spot prices, there are also forward prices, and this is the forward pricing curve. And so the futures markets, the way that they work is that there is a different futures contract for each month into the future going out, currently going out to the end of 2025. So there's a monthly futures contract going out that far. And this is a graph showing the pricing of those contracts. And so because of market conditions of very low inventories and a lot of uncertainty about supply because of the war in Ukraine, we're seeing spot prices all the way on the left-hand part of this graph, and they are by far and away the highest prices that we see in the forward pricing curve. If we go 6 months forward, a year forward, we're seeing prices $1 cheaper than the spot prices are right now, and those are the prices that you can hedge at. And so we look at the forward pricing curve in determining what expected prices are going to be for fuel and what hedge prices can be locked in and whether that's advantageous for the hedger. But currently, diesel can be hedged far lower than where the spot price is. That's not always true. When we saw 2 years ago in April of 2020, this forward pricing curve that you see right here is essentially flipped upside down. The spot market, the spot price was very, very low, and the forward prices were significantly higher than spot prices at the time. Next slide, please. This is again, same graph looking at gasoline, very similar to diesel fuel, very low prices in March and April of 2020. And we see the spike on the upper right-hand portion of the graph here today. So, because both gasoline and diesel fuel are made from crude oil, there's some seasonal differences in consumption, and there's some differences in the refining process, but essentially they present roughly the same amount of risk, but they do have a slightly different pricing pattern, which is why we have two different futures contracts, one for gasoline and one for diesel fuel. Next slide. This is the gasoline forward pricing curve, and so looks very much like the diesel fuel forward pricing curve. Very high prices, spot prices, all the way in the upper left, and then the expectation of lower prices where we can hedge at lower prices as we move further forward in time. You see, it kind of looks like a snake a little bit. That has to do with the seasonality of gasoline consumption and the blending components that go into gasoline. And that's why we see that strange looking forward pricing curve pattern that we don't see with diesel fuel. But again, this is the expected prices where we can hedge. And again, currently gasoline can be hedged quite a bit cheaper, even just 12, 18 months forward from where we are right now than where pump prices are. Next slide, please. So as we were talking about before, the expected range of expected prices, this is another thing that the markets tell us on a day-to-day basis. Not only the forward pricing curve about the estimate or where business can be done for the hedger, but also the level of uncertainty associated with those expected prices. And this is derived from options on futures pricing. So not to get too far into the weeds, but when we price options pricing on these futures contracts, it gives us an idea of how much variability that the market is, how much future volatility and variability the market is anticipating for these futures contracts. And so, and then of course, as you go further into the future, there is simply more uncertainty because of the function of time. But we see this and can react to it when making hedging decisions. Next slide, please. Other market fundamentals that are driving the markets on a day-to-day, week-to-week basis. One of the most important factors is what U.S. inventory levels are, and so when inventories are relatively low, we see the negatively sloped, backward sloping forward pricing curve. People are recognizing a relative scarcity of petroleum, and they're willing to pay up for the prompt delivery of it. Whereas that's why prices are a little bit lower as you go further forward on the curve, because that's not prompt delivery. And so we see this is a 5-year graph of U.S. inventories. You can see back when COVID hit, inventories production could not stop fast enough like demand did, and of course that caused the ballooning of inventories. Inventories have been coming down basically for the past several years and are very low, and are currently sitting right around the 5-year lows. And this is one of the major factors that is keeping prices high. Forward pricing curve very negatively sloped, and certainly the situation in Ukraine, because of that uncertainty, on top of low inventories, that simply exacerbated that situation. So high inventories, cause low prices. Low inventories cause high prices, and this is why, the market really looks a lot to this number and pays attention a lot to this number on a week-to-week basis. The Energy Department releases this information on Wednesday mornings. Next slide. This is U.S. crude oil production. A 5-year look, and we can see that things were increasing during 17, 18, and 19, and then COVID hit, and everybody just kind of shut off the valve as much as they could because prices were crashing. And during the first year or so of COVID, very steady production with a couple of spikes down due to hurricanes and other sort of weather-related events that affect oil production offshore in the Gulf and onshore, mostly in Texas. And then we're seeing, because demand is returning and because prices are moving up, we're seeing U.S. domestic production trending upward, probably not trending upward far enough to allow what we'd like to see, and that's lower prices at the pump. But nevertheless, investment and production in the United States is growing, albeit perhaps a little bit more slowly than those of us would like to see that happen to create lower prices at the pump. Next slide, please. This is OPEC production. OPEC produces about 30% of the world's crude oil, and what they do and their policies influence the market greatly. And so you can see back in 2020 when demand fell off because of COVID, their production had to fall off as well to stop the glut in prices. And they have been slowly returning barrels to the market since mid 2021. And have been doing so at a rate of about 400,000 barrels per day. And so what OPEC does and how they act together has a lot to do with the global petroleum market and prices as well. If OPEC were to just sort of max out their production right now, we would see prices come down very significantly, but they're not doing that. So they're managing that process. And OPEC, and then the OPEC plus countries, which is the Russians and some other members of the coalition. Those are the ones that are currently making the policies to limit production increases to 400,000 barrels per day. Next slide, please. This is domestic demand for petroleum products. And going along very nicely. This is a 5-year look until we get to March of 2020, and then things fell off the cliff and have been coming back ever since. And actually, here in the past several months, we're seeing levels generally higher than where we were in 2019 and 18. But just as of late, we're seeing demand coming down to the bottom of the range that we've seen here over the past 6 to 9 months. And that is not unrelated to price, but demand, especially domestic demand in the U.S. And of course, the U.S. is the largest consumer of petroleum in the world. This has a great effect on price, and this is one of the inputs to what makes the market do what it's doing as far as pricing and the level of the forward pricing curve, and also the level of uncertainty associated with that. Next slide, please. The US dollar has an effect on petroleum price. Oil is priced in US dollars all around the world. So if you are Germany, for example, you need to buy dollars to pay for your oil imports. And so if the dollar strengthens against other currencies, then more of that other currency is needed to purchase the same barrel of oil. So it becomes more expensive in a foreign currency. And so the price in dollars has to come down. It has to adjust downward in order to make that equivalent to that to the buyer in that foreign currency. And so there's this effect that a higher dollar or an increasing dollar puts downward pressure on petroleum prices, and a lower dollar or falling dollar puts upward pressure on petroleum prices. We've seen the dollar come up here over the past month or so to new, close to 2-year highs. And the reason is because higher interest rates, and we have more attractive others around the world want to be owning assets denominated in dollars because of the higher rate of return, and also because of the safe haven aspects of owning dollar-denominated assets, given the uncertainty in Ukraine and what that would mean for investment. Next slide, please. Speculation is one of the drivers of price in the market. Perhaps you've heard in the past, they bring people in front of Congress to see whether speculators are ripping off the public. But basically, changes in levels of speculation can cause changes in price, and either an increase or a decrease, and to do that more rapidly. So if there's developing market conditions, speculators might make it go up or down, depending on what that market condition is, perhaps a little bit more quickly than it would ordinarily have gone in that direction. As of late, we're seeing speculation actually come down because of volatility in the market, and certainly higher prices. If you're a speculator and you see price at $1.30 or $135 a barrel for crude oil, you're really not waiting for much else, and so you're sort of taking that investment, that trade off the table, and realizing your gain off of that. So But we're seeing prices, we're seeing speculation levels be right around the, the 2-year low right now. As at these prices, it's very difficult for speculators to do what they need to do in order to establish positions because of the volatility. Next slide, please. The rig count is the number of oil rigs that are currently drilling new oil wells. And this is an important number because it represents a snapshot of the level of investment that's being made in domestic exploration and production. And so this is one of the things that drives price a little bit longer term. And so as we see more investment in oil production, that means that supply from U.S. domestic producers is going to be higher later. And so this is one of the leading indicators that that the market will look at to see whether there's a sufficient amount of investment being made in new production in order to sustain production and grow production from the levels where it is right now. The interesting thing about shale production is that it is very drilling intensive, and so an oil well that is drilled on the first day has the highest production that it will ever have, and 2 to 3 years later, it will be at a third or a quarter of what it was on day one. So just to sustain production at a constant number is a function of constant drilling process. Next slide, please. And so let's talk about hedging strategy. How do we get hedging done? So if the case for hedging is made, how do we exactly do this? How does it all come down to rubber hitting the road for your organization? So what we do is set up a strategy. And so the strategy for the hedging program, as you might imagine, is when prices, and so this is all kind of a price-driven process, a dynamic hedging strategy that is driven by price information coming out of the market. And so it just makes sense, and this is what I do with almost every one of my clients. We buy when prices are relatively low, and that makes sense. And so we're doing that not only buying more, but buying further into the future at relatively low prices. And this not only has the effect of creating certainty in future costs, but making sure that those future costs where you have certainty are relatively low within a window of historical prices. The other reason, the other thing that you want to do is protect the budget. So if you have prices moving up, and you're not entirely hedged enough for that fiscal period, you may need to be hedging a little bit more on the way up in order to protect that budget. The third tenet would be to maintain a minimum portfolio length, 12 months, for example, 12 months forward, because that would then just give you the buffer to have those future costs known for a sort of a minimum window into the future. So when we see things like Ukraine happening that people can't see 6 or 12 months away, when those things happen, you're essentially you have a higher certainty of what that cost is going to be for a minimum of 12 months forward. But the whole idea of the hedging strategy is to seek overall lowest cost in the long term while taking care of and managing the risks in the short to medium term. Another way of putting that is what is the market doing to me that I don't like, that I like to have change? Or what is the market giving me in the way of opportunity that I should take because it's advantageous? And then finally, a continuously run hedging program through time should seek to avoid mistakes. I've seen mistakes made over the years that I've been doing this, and they're very painful. Mostly hedging too much when prices are very high, and then watching prices come down and being locked into a very high cost for several years. Next slide, please. So what does the dynamic hedging strategy actually look like? What is the opportunity capture? When prices become relatively low, we're buying more. When prices are relatively high, we sort of maintain or don't buy too much. And so this is looking back here over 15 years of diesel fuel prices. And you can see that there are places where prices are relatively low and prices are relatively high. So when we see prices low, the portfolio should be extended. The hedging portfolio, the number of futures contracts should be extended to near the policy maximum. So if we have a policy that allows us to go, 2 or 3 years forward for hedging, that's the instance that should be happening with. When we have prices relatively high, as we saw in early 2014, that's when we're maintaining the portfolio at perhaps the minimum of 12 months forward. When the market changes, when things change, prices come down, that's when you're hedging more. And then you can see how that continues along. When COVID hit, that was an opportunity to buy. Right now is not an opportunity to buy at low price. And this would be the environment in which we would be maintaining that 12-month forward portfolio of futures contracts for hedging. Next slide, please. So this is the other part of the strategy. Not only do we want to buy at relatively low prices, but insofar as we don't buy enough at relatively low prices because those opportunities don't present themselves, we need to manage risk. And so this is hedging only if needed as prices are rising to protect budgets if it's not already hedged. And so if we're looking out to maybe making a budget for the next fiscal year and we're not entirely hedged for that fiscal year, and there's no low priced opportunities that are telling us to buy more, we have to incrementally buy a little bit more on the way up to protect the budget. And so if we, in this example here, the gold line is the 2021 budget. And if prices are moving up and kind of threatening that budget, we're going to add a little bit to the hedging. As prices are flat here, we're not going to add anything because we don't need to. If prices move up a little bit more, we're going to add a little bit more hedging to make sure that the average hedge price stays below this gold line. And then if we move into the next budget year, 22 budget, we're buying in here as prices are moving up to protect against the budget. So we don't want to let your feet get too close to the fire before we're making that next hedge. And so this is simply done at the margin. And if you're not already hedged at relatively low prices, this would be the technique to make sure that you continue to have the budget certainty and to stay below the budget parameter that you've established. Next slide, please. So the parameters and rules for the hedge portfolio and the hedging program is the policy. That's the other part, the strategy. And then the policy is sort of the rules of how this all works together. And so you'd establish some parameters within which the portfolio of futures contracts, the portfolio of hedging is going to be managed. And first of all is the maximum length of the hedge. Do you need to hedge 10 years into the future? Probably not. And so the question is, how far into the future do you need to hedge, or would you like to hedge if you had the opportunity with relatively low prices? And so typically that's going to be somewhere between an 18 and 36-month forward parameter, depending on your organization and how you would be setting up a fuel hedging program policy. But you'd want to have that parameter so the advisor or the committee in your organization isn't saying, let's lock in for the next 20 years because it's really low. That's probably, not something that would be in the spirit of a fuel hedging program that's really looking to control short to medium term cost variability and risk. The other thing is establishing a maximum allowable hedge ratio. And a hedge ratio is the volume of the hedge divided by your expected consumption over the same period of time. So if you have a hedge that is 100,000 gallons and you are going to be, or your projection is that you're going to be consuming 200,000 gallons during that month or that year, your hedge ratio is then 50%. And so in looking at that, the main idea here is to set the goal so you're not going to be overhedged. You want to have the likelihood of being overhedged as low as possible, with the hedge ratio being as high as it can be, in order to increase the effectiveness of the hedging and the forward pricing. And so, if in the municipalities in that world, the consumption of fuel is highly predictable, and that would allow a much higher maximum hedge ratio, perhaps 85, 95%. If you were the California Department of Transportation and you're running all the snow plows in the mountains, well, you don't know how much it's going to snow, so you don't know how much fuel you're going to use, and maybe you would have a maximum hedge ratio of 50% instead of 95. So it has to do with the setting the maximum hedge ratio has to do a lot with the certainty and the regularity and the predictability of fuel consumption in the future. Next slide, please. So other parts of policy: reporting, oversight, advisory. There are reports that are generated to report on the status of the fuel hedging program, what forward prices are or forward costs are expected to be net of the hedge. And so this typically takes the form of weekly updates, a monthly recap, annual reports, policy compliance reports, for the committee, in order to communicate and to oversee the effects of the hedging program to the management and perhaps the board. Oversight, certainly a person or a group of people at the hedging entity, the client, responsible for overseeing the hedging program, receiving the reports, assuring compliance, conducting meetings and calls with the fuel hedging advisor to get periodic updates on the status of the program. And then the advisory portion, which is essentially my role, with my clients, transaction recommendation, monitoring the markets on a day-to-day basis, issuing recommendations, executing orders as need be to operate the fuel hedging program and execution of the strategy. Next slide, please. And so policy, again, looking at different hedging instruments that are available. And so we're talking about what are the sort of contract instruments that are available that make the fuel hedging actually work. And so there's several types of hedging instruments that do that. One is a fixed price supply contract. This is not a financial contract, but a contract that you would have with a fuel supplier, where you would be, telling them, we want to buy, 50,000 gallons next month, and we're asking you to give us a fixed price on that, and they'll do that. The problem with that is that it's typically 10 to 40 cents a gallon more expensive than using financial instruments, because they're providing that service to you. Typically, they won't make these contracts more than about 12 months forward, and if they do, they're going to be significantly more expensive. And these contracts are typically dependent upon the length of the fuel supply contract. So if you have a contract in place that runs out in 6 months, the ability to have a fixed price contract beyond 6 months really isn't there until you have a renewed fuel contract. And perhaps there's no competitive pricing. So if this is a fixed price contract scenario that's being done within a fixed price, or I'm sorry, within a fuel supply contract overall, they're going to just say, this is the price we want to sell this to you at. And that's really not competitive as far as, not getting competitive bids on that, because they're your supplier by contract. They're simply giving you a price that you can take or leave. And so that sort of interferes with the competitive pricing process and contributes to the markup in the transaction. And these transactions are really not regulated. And so unlike financial instruments, there's zero regulation around these fixed price contracts. So if we look to financial instruments, they are typically less expensive, more flexible in use. They are not involved with your fuel supply process. They are away from that, but related to it, because the financial instruments move in value the same way that the price of the fuel at the pump moves, and it's this high correlation to pump price that causes the effectiveness of the hedge. And so it doesn't affect the current fuel supply situation, and they are highly regulated. So there's this, this federal regulation that is around these instruments that are sort of a safeguard, so that pricing is transparent, and there's rules on counterparty credit risk and things like that. So these instruments are highly regulated, and protecting the hedger in the process. Next slide, please. So within financial instruments, we have several different choices. Swap contracts. These are ideal for larger consumers of, say, greater than 10 million gallons per year of petroleum consumption. And these take the form of bilateral agreements with financial institutions. So if you were to set up this situation, you'd be calling, Bank of America, Citibank, Goldman Sachs, and doing a master agreement with them. And then within that master agreement, you'd be making individual hedging transactions. The good part about using swaps is that cash collateral is typically not required. And so you're not having to put up collateral in order to make this work. The second is exchange traded futures contracts, sort of ideal for consumers between 2 and 10 million gallons per year. It would involve the establishment of a futures account with a broker, and there is cash collateral and other cash flow requirements when there is a futures account that's being used. And then the fund that I am currently rolling out, the Linwood Diesel Gasoline Hedging Fund, not a hedge fund, but a hedging fund, is ideal for consumers that are sort of smaller, below 2 million gallons per year. And it's like a mutual fund for hedging. You're pooling your hedging needs with other like-sized entities to gain the economies of scale. It would require a fund participation agreement, and there is cash collateral that's required with that as well. So this is kind of the universe of financial instruments to be chosen. They all economically will be doing the same thing, but just have different features and are more suited for larger and smaller consumers of petroleum. Next slide, please. So as a forward pricing example, this is kind of how this would work from an accounting standpoint. So if you have a budget, say for instance, of $2.60 a gallon, and the actual cost from your supplier on a floating rate basis is $3 a gallon for this month, and you burn 500,000 gallons in a month, you're going to pay the fuel supplier $1.5 million. But because in the 2 to 3 years leading up to this month, you've already hedged 475,000 gallons, or 95%, and you've done that at an average cost of about $2.50 a gallon. Now cost is $3 a gallon, and so you've created a realized gain of 50 cents a gallon. And so what that turns into on 475,000 gallons is a gain of 237,500. This actually, from an accounting standpoint, turns into a negative fuel cost, and that is netted against the actual fuel cost from the supplier. And then you have your cost of fuel net of the hedge, 1,262,500, or $2.52 a gallon, and you're under your budget of $2.60. Next slide, please. Same example, but price goes down to $2 instead of up to $3. And so in this case, $2 a gallon during that month, 500,000 gallons from the supplier, you're going to pay the supplier $1 million. And on your hedge, instead of making 237,500, you're going to have a realized loss of that. But of course, that's coinciding with the lower cost at the pump. And so when you add those two things up, you have your fuel cost net of the hedge of 1,237,500, or $2.47.5 a gallon. And so this is to illustrate from using financial instruments that you would, whether prices go up to $3 or down to $2, you're going to be very close to the $2.50 that you were hedged at, and certainly underneath your budget of $2.60. So this illustrates that you're still paying the supplier, the spot price of fuel, but then the forward pricing, the hedge futures contracts are producing.
Jeff, I think you're breaking up a bit there. Did we lose you? Lee, you may want to jump in until he gets his connection. This may be a good opportunity for you.
Yep, great. And I know we have a limited time here, so
Right.
I will ask that we just advance to my first slide, beyond the introduction, next slide. So, yeah, one of the things that we just heard over the last 50 minutes was basically why I fell asleep in economics in college, but it's all pretty important. I mean, fuel, and we all know from our own budgets that that fuel is a big variable. Our fleet advisors make make best guesses, and so this is not about investing. This is all about managing your budget risk. As Jeff indicated, it's about knowing what your fuel costs are going to be 12 to 18 months out, maybe even 24. And it's also about, with that certainty, understanding that there will be times that you're going to take a loss, as well as those times that you're going to have a gain. If we go next slide. Know that if you're going to do this, there are going to be critics. I've done this fuel hedging concept in 3 cities, Palm Bay, Fort Lauderdale, and Gainesville. And these are the typical questions that you're going to get from your staff. We get a great price already, right? You tap into contracts. Maybe it's a school board's contract, maybe it's a transit agency's contract for actual fuel. You'll hear that this may violate federal transit rules if you operate a bus fleet. And of course, then what happens during a hurricane? All those basically go away because you're not changing where you're buying your fuel from. If you buy it from vendor A, you're going to still continue to buy it from vendor A. What you're doing is you're buying a financial instrument to hedge your price and create some certainty. And you'll hear that this violates our investment policies, and it doesn't, because it's not an investment tool. And then you'll hear that we don't buy enough fuel, and that's what I think Jeff was talking about. Just as he was getting cut off from us, you don't have to worry about how much fuel you buy each year. There are instruments that you can use that will match the delivery of the fuel that you take on that. So if you're taking delivery every 60 days, your hedge will be based upon delivery of every 60 days. Next slide. So where did I first hear about this idea? I think I was reading the New York Times back in 2007 when Southwest was being lauded over their fuel hedging and what made them profitable when other airlines were starting to lose their profits because of fuel. And I said, if airlines could do it, why can't we do it with our municipal fleet? And then it turns out electric utilities have been doing this all along with their natural gas programs where they've been hedging. So not a new idea, but I think it's an idea that's been out there at least for about 15 years in the municipal fleet world. Next slide. So as I mentioned, I did this in 3 cities, Palm Bay from 2008 till I left in 2011. During that period, coming into the Great Recession, $491,000 in realized gains, $146,000 in unrealized gains when I left. That wasn't a bad return, and you can't see those numbers, but that's basically what the brokerage account looked like on a month-to-month basis. Next slide. Fort Lauderdale, same thing, good realized gains. You'll see that I drew a line between fiscal year 20, both from the time I was there and then the time I just left. You'll notice that the unrealized gains in the beginning of fiscal year 20 turned into realized losses in there. You just got to expect that the numbers are not always going to work in your favor. But as you can see, if you stick with the program into fiscal year 21, 22, and then looking into fiscal year 23, those gains come back. And as Jeff indicated, everything basically goes to zero. Next slide. When I got to Gainesville, established the program again. This is, the results right up to March 31st. Started the program in mid fiscal year 20, and looking all the way through fiscal year 22, $1.3 million in realized gains, close to $1 million in unrealized gains at this point. And with today being the first day of Major League Baseball, if you go next slide, I wanted to just leave you with the words of wisdom of Yogi Berra. If you don't know where you're going, you might wind up someplace else. And that's really the essence of the fuel hedging program, is that it's going to create that certainty. You're going to know where you're going for the next 12 to 18 months. And overall, I would encourage everybody on here to look at this as a best practice and think about how you can bring it back to your own city. And I'm not sure if Jeff was able to rejoin us, but I know we're approaching the end, but I think there's time for some questions.
I'm back on. Yep.
Okay.
Thanks, Lee, and thanks, Jeff, very much. Extremely informative, and I've put aside any provocative questions I may have. Wanted to make sure, Lee, you had a chance to cover what you needed to cover. Let me just suggest this, since we don't have any questions in chat at the moment. I think people were just taking some notes and considering their own personal situations. Let me just ask you if there's anything, Jeff, that you wanted to, you got cut off there. If there's any final points you'd like to make, or Lee yourself, if there's any final points you'd like to make before we adjourn. And I'll start with you, Jeff.
Yeah, I mean, I think just the, asking the question again, I mean, where is the advantage to having your, your organization, your municipality? Where's the advantage of having that organization exposed to the uncertainty and volatility of energy markets? And that can be controlled, and it ought to be controlled. And so that's, kind of passionate about that, obviously, but it seems like as Lee mentioned, a best practice. It brings certainty to your fuel costs and enhances the overall financial well-being of your organization.
Jeff, we do have a question that's come in. Lee, I think this one may be for you. It says, in the year the hedge is funded, did you budget 100% fuel cost and then 100% for the hedge as well?
No, not at all. What you do is you look at the hedge will tell you that you are going to pay $1.19 a gallon in the month of October and $1.24 in the month of November. And so you look at your fuel usage and basically do a forecast on that. So you will need to fund up a brokerage account, and you will need to be prepared if the hedge doesn't go in your favor of funding the difference on that. But I'd always had done that over reserves in the beginning, and then your brokerage account over a period of time should have sufficient funds in it to cover any payments that you need to make, in essence, to the bank on there. I think I put in all of our in all three cities about 300,000 into a brokerage account just to fund up the program.
Lee and Jeff, just a quick follow-up. Jeff, you covered the important aspect of policies. Just like any investment, you should have an investment policy. Could you just quickly go through again, either you or Lee, what official or formalized policy you would have if you're going to be looking into doing hedging of fuel?
Lee, is that you or me?
Why don't you go ahead and take that, and I'll jump in. And I apologize for being distracted. Here in Tel Aviv, we just had a terrorist attack, and so people are just checking in with everybody to make sure we're all safe. So
good.
All the best, Lee.
So from a policy standpoint, the things that the things to address is essentially, the parameters in which the program will run, and really the purpose of the program. So the first thing you have is a mission statement saying this is what this is for. This is not an investment. It's a forward pricing tool, and we're doing this because we desire higher budget certainty. And so there's sort of a statement, a mission statement, and then you get into other elements of policy. What's the maximum forward period that you can hedge? What's the maximum hedge ratio, which is the percentage of projected fuel usage that you can hedge up to? And then other things, what's the role of the committee or the individual at the hedging organization? They're receiving reports, perhaps ensuring compliance with the policy, things like that. So a policy is really meant to sort of define what the program is, how it's going to operate, who's going to operate it, and what the purpose is.
Jeff, thank you. And Lee, thank you both. Our time is up, unfortunately, but we sincerely appreciate the time that you put in preparing this PowerPoint for all of us and your presentation. Lee, thanks for joining us from overseas. I hope you're safe and everything is fine over there, but appreciate you putting your time into it and continuing to be such an advocate for professional management here in Florida. With those comments, just let me at least acknowledge the FCCMA Professional Development Committee. They've done a super job of these topics and really appreciate very much the way they organize these webinars. So with those comments, thanks everyone again, and we're now adjourned.
Okay.